This is Warren Buffett. He is widely regarded as the greatest investor the world has ever seen, and is currently sitting at number 5 on the Forbes rich list with a net worth of over $100 billion. You can only imagine the amount of money this man brings home every year. Now I want to ask you a question. Considering that the average single worker in the US pays close to 23% in tax every year, how much tax do you think Warren Buffett pays? 30%? 40%? 50%? No, he pays 1%. Except he doesn't. He actually pays 0.1%. That's right, Buffett shocked the world and in the process angered social justice warriors when he announced that he was in fact paying less in taxes than his own secretary. That is, on a percentage basis at least. And this isn't an anomaly amongst the world's richest people. Jeff Bezos, founder of Amazon, pays 0.98% in taxes. Mark Zuckerberg, founder of Meta, pays 1.1%. Elon Musk, the richest man in the world, pays just 3.27% in tax. And then there's you. You're probably working a job right now. At the start of each year, your employer mails you your tax statement, and without question, you go through the motions of copying that information over to your 1099 tax form. You send it off to the government thinking, why is 28% of my income lost to taxes? How are people making more money than me paying less tax? Why do the rich pay so little tax? This isn't fair. You come to the conclusion that the tax game is rigged. You have to be rich enough to hire world-class accountants to save money on taxes. There's no way a normal person like myself can reduce their tax liability. But what if I told you you were wrong? There are ways that you can pay less tax and save more money each year, all within the legal confines of the tax code. Today, I'm revealing the legal tax secrets the wealthy commonly use to reduce their tax burden, and by the end of the video, you'll know how to do the same. An example of the first secret method the rich use to reduce their taxes is found in the intro of one of Logan Paul's podcasts.
Can you find me a jet? He's like, I'll call you back. He calls him back. He's like, dang, dude, nobody's ever done that. The entire amount. I'll find you a jet. They found me a jet. I took delivery of it on December, like 26 or something. Okay. Wrote off the entire thing.
You wrote off a jet?
The entire thing.
The business.
It took care of all my taxes that year and the next year and halfway into next year.
So that was Grant Cardone. He's pretty infamous in the YouTube entrepreneur space. Most people consider him to be a bit of a fake guru, but if we can trust him with anything, it's how to avoid paying taxes. What he just described was one of the most important things the wealthy use to reduce their taxes, which is tax deductions. The rich use tax deductions to lower the amount of their income that's considered taxable. Here's how this works. Let's say Grant Cardone makes $10 million this year. If he doesn't do anything about it, he's going to owe the IRS a lot of money in taxes. So what does he do? He finds a way to reduce his taxable income. He ends up buying a private jet for his business that also costs $10 million. The cost of the jet can now be deducted from his income. And now in the eyes of the IRS, he didn't make $10 million, he made $0. He doesn't have to pay any taxes this year. Now ask yourself this, how can I personally use tax deductions to save money on my own taxes? Because the tax code actually is pretty favorable to us normal people as well. You don't need to own a massive company to benefit from tax deductions. If you have a side hustle or even a freelance gig, you too can write off your expenses against your personal income. The way I do this is with this YouTube channel of mine. Last year I bought stuff like this, and this. And all of these things are technically considered business expenses. Now tax deductions are one thing, but let's talk about how the rich are able to grow their wealth without paying taxes. They invest in assets. Between 2020 and 2021, billionaire wealth grew by $4.4 trillion, and at the same time, more than 100 million people fell below the poverty line. If you've ever wondered how the rich were able to grow their wealth at a time when everyone else was just trying to make ends meet, this is how they did it. They invested in assets. You see, over the last few years, the value of assets like stocks and real estate skyrocketed. And where do you think the rich were holding most of their wealth? In stocks and real estate. By owning investments, you're able to build wealth in a very tax-advantaged way. Let me show you how this works. Let's say you're the average Joe living paycheck to paycheck. You say enough is enough and you decide to pick up an extra shift at work. And this makes you an extra $10,000 a year. But of course, you don't get to keep all of the $10,000. The IRS is going to take their cut first, maybe around 30% or so. Now you're left with $7,000. You deposit this money in your checking account and do this for a total of 10 years. Every year, you're losing 30% of your income to tax. After 10 years, you may have made a total of $100,000, but you're only left with $70,000. Now compare this scenario to how most rich people build their wealth. Let's call this person Warren. For comparison's sake, let's say Warren also makes an extra $10,000 a year just like you. But unlike you, Warren is familiar with the tax code. He knows that if he invests his money into stocks that are held in a tax-advantaged account, something like a 401k, then he doesn't have to pay any upfront taxes on his $10,000. Both the money he invests and the return those investments generate are all exempt from being taxed. So he does just that. He invests his $10,000 into stocks every year, and those stocks return an average of 10% annually. At the end of the 10 years, he has a stock portfolio worth $159,310. And the only time Warren's money will be taxed is if he chooses to sell his stocks. Even then, his money is taxed at the long-term capital gains rate, which is at most 20%, which is much lower than the 30% income tax that you've been paying for the last 10 years. By knowing the tax code and investing his money, Warren was able to turn the same $10,000 income that you were making into over twice as much money as you did. So let's talk practical now. What can you actually do right now to invest in assets to save you money on taxes whilst also building wealth for you? The first and easiest step is to see if your employer offers a 401k retirement account. If they do, you'll be able to invest your money into stocks tax-free. And what's great about this option is that your employer will often offer to match the amount of money you invest. So let's say you invest 3% of your paycheck every month into your retirement account. Your employer may offer to match that number by also investing 3% on your behalf. And if your employer doesn't offer a 401k, don't worry, because you can also open up a retirement account by yourself. I would recommend opening up a Roth IRA through an established provider like Vanguard. And by doing this, you'll be able to invest up to $6,500 every year, and that money will grow tax-free. But tax deductions, investing, these first two strategies might lower your taxable income, but they don't directly lower your tax payments. But something that does is tax credits. We all know that the rich and famous love to own electric vehicles. But why is that? They say that it's because they just care so much about the environment.
But we also love equally as much our environment.
And they say that it's so important for all of us to do our parts by reducing our own carbon footprints.
Denying the very science of this climate catastrophe.
Meanwhile, they can also be spotted flying around on their private jet on their weekly trip to the grocery store. Well, it turns out that the real reason they own electric vehicles might have less to do with caring about the environment and more to do with saving money on taxes. That's because when you purchase an electric vehicle, you can typically qualify for something called a tax credit. Now, this is not the same thing as a tax deduction. It's much better. Let me show you why. Let's say you make $100,000 a year. If you receive a $10,000 tax deduction, your taxable income is $90,000. Let's say you're then taxed at a rate of 25%. Your tax bill comes out to $22,500. All in all, you save $2,500 in taxes. But now let's say, instead of receiving a tax deduction, you receive a $10,000 tax credit. Your taxable income isn't reduced, but now that $10,000 tax credit is applied directly to the $25,000 in taxes that you owe. Your tax bill comes out to $15,000, and all in all, you save $10,000. So think about the money you save from tax credits as effectively free money. It's a dollar-for-dollar reduction of your taxes.
Fun coupon! See that? A fun coupon!
Now, how can you personally save money with tax credits? Well, there are a lot of tax credits out there, but here are a few that are more likely to apply to you. Make sure you research these and claim them this tax season, because I'm willing to bet that at least one of them applies to your situation. You might find yourself with a bit of extra money after applying all these tax saving strategies. If you do, then you have to make sure you don't fall into money trap number 3 that I mentioned in this video, or you might lose out big time.